It has been another crazy day for global financial markets, and we just learned that President Trump is instituting a 90-day pause on tariffs. Wall Street loved the news, and we are seeing just a huge rally in the stock market. We've been getting a ton of questions from WSJ subscribers about the rally today and the market moves over the past week. Let's dive into some of them now. We have a question here from Kimberly. Does today's jump in the stock market, due to the pause in tariffs, make sense given that Trump raised China's tariffs to 125%? This is a great question. We are seeing a historic rally in the stock market. At one point, the NASDAQ was up around 11%. So this move shows that investors were just desperate for any whiff of good news surrounding tariffs. These tariffs have battered investors' portfolios over the past week and made many anxious that we're going to see a recession soon. So investors took this positive development in stride. Of course, we're not out of the woods yet. We don't know what's going to happen in 90 days once this pause is over. And of course, we are still locked in this trade war with China. Our next question is from Ronald. How will the tariff debacle affect the California municipal bond market, and when to buy? So the municipal bond market is a really good example of how these tariffs can ripple through the entire U.S. economy, affecting tiny municipalities like a school district in Michigan or cities as big as Los Angeles. Think about it. Let's say these tariffs go into effect and we do tip into an economic downturn. That could impact municipalities all around the country which depend on tax revenues. Say your friend Joe loses his job. He's less likely to take that bachelor party or go on that big trip or eat out at a restaurant. All of that impacts sales tax revenues. Of course, if he's out of a job, he's also going to be paying less in income tax. That affects municipalities and could really dent their finances. Our next question is from Christian. Christian asks, how likely is the Fed to step in to save markets? The short answer is not very likely. In March 2020 and during the global financial crisis, the Fed quickly stepped in to save the financial markets. This time around, there's one big reason investors don't think the Fed will do the same, and that is inflation. Inflation has been a problem for everyday Americans for years, and the Fed is still trying to bring inflation back down to 2%. Now, the tariffs threaten to increase inflation, and that is one big reason a lot of investors don't think the central bank is going to save the markets this time around. Our next question, is there a sense of where the trillions of dollars in the stock market decline have gone? The market has bounced back today big time. The NASDAQ, S&P 500 are recording some of their biggest one-day gains since the year 2000. But the past few days have been a really different story. And what we've seen is that a lot of investors have been hiding out in cash. Assets in cash-like investments, money market funds, hit a record of more than $7 trillion recently. That's the highest in records going back to the 1970s. So the short answer is that a lot of investors have been keeping their money in cash. Thank you guys so much for all of these questions. Please keep them coming on WSJ.com.